Hello friends, welcome everyone to my channel. Please subscribe, like this video and let's talk about the economy. And let's begin. And let's talk about the bank's interest rates. Russia's high interest rates and the impact of the lower middle class. Economic experts are raising concerns that Russia's high interest rates are putting in lower middle class at risk and could increase inequality. High interest policies may lead to asset redistribution, ultimately benefiting the wealthier segments while increasing their incomes. The Central Bank of Russia's strict monetary policies are expected to have an impact on inequality, with economists pointing out that higher interest rates may harm individuals without savings but with debts. Meanwhile, wealthier Russians are likely to profit from higher interest returns, while the poorest might benefit from reduced inflation. In October, the central bank raised the key rate to a record 21% due to high inflation. According to central bank chair Elvira Nabiullin, strict monetary policy is a necessary reaction to the economic situation and helps protect salaries, pensions, and savings from price hikes. The effects of monetary policies on inequality have been a topic of discussions in the West, especially after various measures were taken to stabilize the economy following recent crises. Experts at the European Central Bank identified three main channels through which monetary policies impact household wealth distribution. First of all, interest income and borrowing costs. Rate changes affect savers and borrowers differently depending on factors like age and income. Asset value. Household asset portfolios vary, meaning some benefit from policy changes, while others suffer losses. Labor demand. Employment is impacted differently across individuals, depending on their unique characteristics. Studies by the European Central Bank show that previous loose monetary policy in the Eurozone between 2008 and 2019 didn't significantly increase inequality. The middle class benefited from lower interest rates due to mortgage savings, while wealthier households faced reduced interest income due to low debt. Russia's current policy environment presents new challenges, with economist Oleg noting that Russia has reached a point where the redistributive effects of higher rates cannot be ignored. As inflation and key rates rise, those with savings and assets may pull further ahead, while heavily in-debt individuals couldn't raise worsening financial conditions. Economist conjectures suggesting that higher rates will primarily impact Russia's lower middle class, especially individuals without savings but with loans. Higher borrowing costs could limit wage growth in the private sector, leading to financial strain on those unable to offset loan repayments with interest earnings. Conversely, Belousov predicts wealthier households with minimal debts will profit from high interest savings, particularly in a monopoly-linked sector. The poorest citizens whose spending is focused on essentials are less likely to be affected, as they generally don't take out significant loans. But the best group chief economist Radian Latipov argues that while rate hikes are temporary, they are necessary to curb inflation. Lower inflation can protect against inequality, as it minimizes the erosion of savings for the less affluent who lack inflation hedges. Ultimately, the combination of interest rates above 20% and 8% inflation is unsustainable, Economist Alexander Isakov believes that restrictive policy will slow economic activity and price growth, likely returning Russia to a stable equilibrium with 3–5% inflation and 10% interest rates within the next few years. And the Moscow exchange is seeing a significant decline in yuan trading, with volumes dropping to the lowest in nearly 2 years. Lower foreign currency inflows from exports and United States sanctions have impacted trading in the last available foreign currency on Russia's exchange. According to Kommersant, yuan trading volume on Moscow exchange in October fell to its lowest since February 2023. Exchange data shows that traders conducted tomorrow yuan transactions worth 1.8 trillion rubles for the month, down 10% from the September and 20% from August. Compared to January-May levels this year, yuan turnover has nearly halved, with daily average volumes dropping below 80 billion rubles. Since the Moscow exchange was sanctioned by the United States in July, dollar and euro trading has ceased. The United States Treasury had allowed transactions on the exchange until October 13. But with the license now expired and trading risks secondary sanctions, this discourages foreign participants, noted Sovcombank's chief analyst Mikhail Vasilyev. Even before the licenses expired, Bank of China, and one of China's largest banks and clearing agent for yuan traders, ceased its operations on the exchange. This left the Industrial and Commercial Bank of China as the sole provider of yuan traders on the exchange. Russian importers who needed yuan to pay for Chinese goods are also leaving the exchange. Head of analysis of the other bank explains that Chinese banks often reject yuan purchased on a sanctions exchange, pushing business and banks on the over-the-counter market. According to the central bank, this market yuan trading now makes up more than 67% of the market. Sberbank's vice-president Skvartsov warned in August that yuan trading on the exchange could end soon, noting that sanctions are constantly evolving and Sberbank has a contingency plan in place in the exchange halts yuan trading. What do you think about this? Please subscribe to the channel and like this video. Thank you for all.